The Public Investment Corporation has signaled strategic patience when it comes to the potential tie-up between Anglo American and BHP. In an exclusive interview with Business Day, PIC Chair David Masondo stated that the asset manager will assess any offer. The PIC is Anglo's biggest shareholder and has already been called on by COSATU to reject any possible BHP-Anglo tie-up. The union feels that the deal would not be in the national interest. That's as one of the sticking points in BHP's offer is a plan to exclude Anglo South African assets in a scenario that would see Kumba and Anglo American Platinum hived off and their shares distributed to Anglo shareholders. Anglo did dismiss this initial takeover proposal last week, but it's expected that BHP will return with an improved offer, although analysts believe BHP will still want Anglo to drop its exposure to SA. Anheuser-Busch InBev has reported a 2.6% rise in sales in the first quarter. That's as the effects of a year-long Bud Light boycott hurt the brewer. But the backlash is expected to have a smaller effect on results in the coming quarters. Normalized earnings before interest, taxes, depreciation and amortization rose 5.4% during the period. And the brewer expects full-year EBITDA to grow in line with its medium-term outlook of between 4% and 8%. Canal Plus has increased its holding in MultiChoice to 43.54%. That's as the French media group forges ahead with its bid to take control of Africa's biggest pay TV operator. Last week, the takeover regulation panel granted MultiChoice and Canal Plus an extension to distribute a combined circular to shareholders outlining details of the French group's bid to take over MultiChoice. The panel has given them an extension to June the 4th to release a circular. In a joint statement, the company said they had asked for the extension to allow the independent expert and the independent board enough time to properly fulfill their responsibilities. Lesaka has signaled a new deal to buy local fintech operator Adumo. The transaction carries a price tag of 1.6 billion rand, and that will be made up of a combination of stock and cash. Adumo is South Africa's largest independent payments processor. Lesaka, which provides informal retail merchants with point-of-sales devices, says the acquisition reinforces its position as a natural consolidator of Southern African fintech. The company added that the deal will also enhance the firm's strengths in both the consumer and merchant markets. Capital & Regional is on the hunt for a new CEO. That's as Lawrence Hutchins has announced his exit from the UK-based shopping centre REIT. He leaves to pursue a new business opportunity after 7 years in the role. Hutchins is subject to a 12-month notice period and will continue as CEO during this time, while the firm seeks a replacement and a smooth and orderly transition can take place. SPAR is the latest company to seek a secondary listing on A2X. The wholesaler's shares will be available to trade on the exchange from the 15th of May. The firm will retain its listing on the JSE. SPAR CEO Angelo Swartz says the secondary listing will allow investors to have easy access to the firm's stock at very low transaction costs. It will also improve liquidity. SPAR's listing will bring the number of instruments listed on A2X to 184, with a combined market capitalization of around 9.4 trillion rand. And high debt levels are weighing on South Africa's middle class. The first quarter debt busters debt index shows that individuals earning more than 35,000 rand a month are bearing the brunt of diminishing disposable incomes. That's as many are drowning in debt and facing a combination of high interest rates and inflation, as well as stagnant salaries due to a lack of economic growth. The debt-to-income ratio for people in that earnings category came in at 172%, with most of the debt being home and car finance. On the international front, BMW has warned of a slight drop in pre-tax profit this year due to higher research and development, manufacturing and personnel costs, and a decrease in used car prices also contributed to the decline. Let's take a look at this package report for more.
BMW expects a slight drop in pre-tax profit this year. It cites higher research and development, personnel and manufacturing costs. It also sees a fall in used car prices as contributing to the decline. The German auto giant on Wednesday reported a fall in its first quarter profit margin in the automotive segment. It blamed persistently higher costs weighing on its bottom line, while demand for luxury cars in China was muted. The automaker's pre-tax margin in the car segment fell to 8.8% from 12.1% a year earlier, below analyst forecasts. First quarter revenue dropped slightly despite a slight rise in car sales. Q1 group pre-tax profit fell just under 19% to $4.4 billion, but beat analyst forecasts. Sales of fully electric cars rose 28% to 83,000 vehicles during the period. BMW is investing heavily in EVs and model revamps across its lineup. It expects record spending this year, up from more than $8 billion last year. BMW rivals Mercedes-Benz and Porsche have also spent big. German car makers want to tackle growing competition in the EV market from China and Tesla.
Now on a move to dump fossil fuels, the German government is mulling a multi-billion euro investment to strengthen the country's renewable energy infrastructure. Here's our reporter Darling Lachela with more insight.
That's right, Zinati. Germany has actually been working hard on its energy transition, moving the country out of fossil fuels and into renewables. But there have been more than a few hiccups, and now Berlin is pondering a big investment that many see as a game changer. And joining me with on-the-ground insight on that is Lars Halter from Deutsche Welle. Thanks so much for joining us today. Now, Lars, let's get straight into it. What can you tell us about the deal the government is working on right now?
Yeah, thanks for having me. Well, this is quite a complicated story, so let me start by saying who's involved. RWE, or RWE as they're called in Germany, is one of the largest German energy providers. It started with a few coal-fired power plants over 120 years ago, and as of last, the company has been running all sorts of power plants, including nuclear, but also some 20 wind parks. And RWE has also had a major stake in a company called Amprion, and that is one of 4 German transmission system operators. Now, those are the companies running what's possibly the biggest and most important part of any country's energy infrastructure. It's the power lines that are transporting electricity across the country, often through overland lines, but also more and more, of course, through a network of in-the-ground infrastructure. Now, RWE's share of that company, Amprion, might come up for sale, and the German government is interested in taking it over. However, that won't be cheap, neither now nor with regards to future investments.
And what makes this deal so difficult, or rather so expensive?
Well, mostly the fact that it's hard to put a valuation on the infrastructure that you're buying. Amprion has an asset base of over 8 billion euros, and the purchasing price could be slightly above that, but that still might be pocket change compared to what comes next. Another couple of billions needed in investment into the grid. Now, such an investment would be hard for anyone to stem. At least the government can likely afford it a little more easily than any private investor. But one problem remains: it's an unattractive investment when seen solely for its financial aspect. It will cost a ton of money and not pay much of a dividend until years or maybe even decades into the future.
Now, given the cost, is this still a good idea for the German government?
It seems so. The energy grid is, of course, part of any country's critical infrastructure. So to have that owned, or at least partially owned, by the government certainly has its advantages, especially in a country where there's 4 different companies running transmission systems. There's also 50 Hertz, Transnet and Tenet, all of which are already partially owned by the government in Berlin. Now, if the government would buy a stake in the 4th big player, it would have a lot more influence over the future of the entire business and could even create a combined business, merging all 4 companies into one big national grid provider, as has been done in many other countries. The problem with this idea, again, is the high cost. Experts say these networks combined will need about 300 billion euros worth of investment over the next 20 years. And you've heard that right, 300 billion euros. That is mostly due to the fact that there have been big changes in the way energy is produced. More energy is coming from offshore wind farms these days, and it's enormously expensive to connect those to the power grid. Then, with the rise of electric vehicles, demand has risen for charging stations across the country. Now, that's not entirely new, but Germany is way behind in developing a decent charging infrastructure, so massive investment will be necessary there as well.
Lars, let's leave it there. Thanks so much for your time and those insights. That was Lars Halter joining us from Berlin.